So just to confirm, you can able to see my Word file, right? Chapter 3.
Yes, Gauri.
Yes, sir.
Now can you see the Excel?
Yes, sir.
Okay, great. So I'll go on with English itself. I thought like there are other people from other states also joining. But if anybody don't understand much English, maybe you can ask me to explain in Tamil. I will also do that in, but I don't know other languages. Let's make it a little bit user friendly so that everybody understands it. So the main aim is not to speak in English, it's to make you all understand. Okay, so we have two chapters today. So we'll try to finish it up as early as possible and we'll take a break in between two chapters. So the first chapter in today's session is on the chapter 3, that is plans of life insurance. So we are going to see all the plans related to life insurance, not other insurance. The second one is we are going to, on chapter 4, we are going to see about annuities. Anybody knows what is annuity? Yes,
It's like a
annuities.
pension.
Yes, annuities are pension. Thank you so much. So annuities are pension plans. So first we are going to see all types of plans. Second, we are going to see something related to pension plans alone. So that is very small pension plans. We'll cover it up in 30 minutes. This one will take a little bit longer. So life insurance plans overview. Life insurance plan usually covers only two things. One is death, one is survival. Survival means after a period of time, if the patient survives, he is not dead means you will get the benefit. Death cover means during that term, if you are taking 10 years policy, if you are dead in between any of that during that time, you will get paid. Only two types of basic type of insurance. One is death cover, another one is survival benefit. Survival benefit is maturity plan. I think most of you will know about survival plans. LIC and all, if you are going for investment savings, you will go with survival benefit only. Very few will take death cover alone. Death cover is not related to any kind of savings. It is just covers only death. If you are not dead, no benefit will be paid. Whatever you paid, it will go. It won't be get paid back. So that is called death cover. Like a motorcycle insurance, motor vehicle insurance, your bike insurance. Every year you're paying 1,000 rupees to take that bike insurance, but after 1 year they won't give anything back. Only if accidents happen, they will pay you. Otherwise, they won't give return the premium and all. So next year you need to pay again one amount and you need to take it. Like that, death cover is only if death occurs they will pay. Otherwise, they won't pay. So there are a lot of traditional insurance plan, but we are not going into deep on this. Only few we will see. The examples are, life insured, minimum, maximum, sum assured, entry age. These are all like few, um, features that you need to know. What is the entry age, minimum premium, plan term, premium frequency, step up and step down options, and riders. Okay, in that there are some important terms like riders and all. We'll see what are those. So term insurance plan. Term. Remember this one, term insurance plans are death cover. Okay, so we have seen death cover insurance. The name of that policy is term insurance cover. It will cover only death. So it is the very basic low premium insurance. For example, if you are taking for 1 crore, if your age is 25, if you are taking for 1 crore, that 1 crore you may need to pay maybe 10,000 rupees in a year. If anything happens to you, your family will get that 1 crore rupees. Okay, so this is very basic insurance and very low premium. This is the lowest premium. And nobody takes this one because they want always return. They want the cash back. They don't want to waste money. But this covers the pure financial aspect of your family. If you are the only breadwinner of the family, then if you are not there, somebody has to some money has to be there in their account to run their life, your wife, your children, etc. So you cannot earn so much of money quickly. So that people takes term insurance. Term insurance, the 10,000 rupees for 1 crore insurance is easily affordable. Just less than 1,000 rupees you are going to pay in a month. So anybody can take. So this is the beauty of term insurance. But no insurance company will directly tell this one because there is no benefit for them. Okay. No major profit comes for the insurance company when they are giving term insurance. So endowment plan. So in this we have pure endowment plan. It is not term insurance, but I'm just explaining it. Pure endowment is if you are surviving. This is totally opposite of term insurance. Term insurance pays death. Pure endowment pays when you are surviving. That means if you are taking 10-year policy, if you are alive after 10 years, they will pay. If you are dead within 10 years, they won't pay. This is pure endowment policy. This is not in India. So they are not allowing this pure endowment policy in India. They have modified endowment. That is called endowment insurance plan. This has two parts. Okay, one is it covers both death as well as survival. Even if you are dead within 10 years, they will pay. Even if you are surviving, they will pay. Okay. So this is called endowment insurance plan. Pure endowment is not available in India. So they are not permittable in India. Okay. So it is frequently asked question. Which insurance plan is not permitted in India is pure endowment, not endowment. Okay. So endowment is combination of two plans, pure as well as pure term as well as pure endowment. So if you die, you will get. If you survive, also you will get. This is both beneficial to cover family financial risk as well as to have some. If you are surviving, if you are at age 60, if you are still surviving, you will get some amount to run your life after retirement. This is called endowment insurance plan. In this, bonus also is there. For example, participating plan, non-participating plan, two are there. So participating plan means insurance company, the premium that you are paying, okay, that insurance company will put that premium in some stock markets. This is called participating. After putting that in the stock market, you will get some amount of interest. For example, they are earning 12% interest from stock market. In the 12%, they will pay, for example, 6% they will pay it to you as a bonus because it is your money. On your behalf, insurance company is paying, investing. Okay. So they will take 50% and they will give 50% as bonus. This is participating plan. Non-participating plan, they will say, I'm going to keep your money. I'm not going to invest anywhere. But since I am keeping money, I will pay minimum interest, maybe 5% interest, like savings account. They will pay some interest. So this is called non-participating. So in endowment plan, they may invest your money and they will give you bonus also. So bonus part is also there. Double endowment. So double endowment is you will have term insurance plus 2 times of survival benefit. For example, if you are investing for 5 lakh sum insured, your insurance, you are getting sum assured, that is life insurance policy for 5 lakhs. If you die within 10 years, you will get 5 lakhs. If you survive after 10 years, you will get 10 lakhs. So that is called double endowment policy. Okay. Then we have whole life. Whole life is very simple. The name itself is has. Whole life means up to 100 years they will cover, lifelong. There is no term like 10 years, 20 years and all, it is not there. For the entire life, they will cover. And this also has other components like survival benefit also is there. and also there is bonus amount paid to you if there is some interest accumulation is there in the participating policy. So this is something exam they will test life expectancy at birth in India. Okay, usually average Indian will live for 70.8 years. Okay, healthy life expectancy is without any disease. They will live for 60 years. After 60 years, most of the people will get some other disease, one or other disease. Any questions so far? Okay. So let me give an example in an Excel to understand it more better. So this is sum assured. We'll see about sum assured, death, survival benefit, and bonus. So term policy has sum assured 5 lakhs. Example, if you are dead, they will give 5 lakhs. If you are surviving, no benefit, zero benefit, and no bonus. Okay. So pure endowment, if you are taking for 5 lakhs, if you are dead, they won't give, zero. If you survive, they will give 5 lakhs. There is bonus in this endowment plan. And combined endowment, that is pure term plus pure endowment. So if you are taking for 5 lakhs, if you are dead, they will give 5 lakhs. If you survive, they will give 5 lakhs. Bonus is there. Double endowment. If you take for sum assured 5 lakhs, if you are dead, they will give 5 lakhs. So death benefit is not doubled. Only the survival benefit is doubled. Double endowment. Okay, that is the meaning. If you survive, they will give 10 lakhs. Bonus is there. Whole life, sum assured 5 lakh. If you are dead, they will give 5 lakhs. If you survive, they will give 5 lakhs. Bonus is also there. The only difference between endowment and whole life is endowment is for limited term, whole life is for the entire life. Okay. Then we will go for money back. Money back is this, most of us will know. LIC, they will push only money back policies. That means if you are investing, if you are paying premium, they will give returns in some periodic terms. That is, after 1 year, you will get some amount. After 2 years, you will get some amount. After 3 years, you will get some amount. Like that, they will promise when you're taking the policy itself, like that they will pay. It is not after survival, after the end of the term. If you're taking a policy for 20 years, 5 years, they will release one bonus. I mean, one amount. That is bonus amount. After money back amount. After 10 years, they will release another money back amount. After 15 years, they will release another money back amount. After 20 years, they will pay the survival benefit. If you have died in between, they will pay the death benefit also. Okay. So this is called money back or cash back insurance plans. So this is also like sum assured if you are taking for 5 lakhs, they will cover death for 5 lakhs. 5th year survival. This is an example. 5th year survival, they will pay 1 lakh, not the entire amount. Okay. 10 year, they will pay 1 lakh like that. And survival benefit after 20 years also they will pay, and bonus also they will pay. So this is for someone who don't want to wait till the survival period. If they want to get some money in between, so they can take money back or cash back insurance plans. Any questions so far? So convertible plans. Convertible plan is you're taking an insurance plan now, and they will promise you can convert that plan into any plan in the future. So if you're taking term plan, you cannot convert. Whole life, you cannot convert. Okay, if you're taking money back, you cannot convert. If you're taking a convertible plan itself, you can convert from any plan to any plan. So that is at the starting itself, the insurance company will say this is a convertible plan. You can convert from term to whole life to term. Any other plans you can convert anytime. What is the advantage of taking convertible plan? Okay, so now maybe our salary will be low. We may be thinking like, I can pay only 10,000 rupees in a year. So I'm taking term insurance. Maybe after getting married, I'm thinking whether I can get some money back. So I want to change that term insurance to money back. You can go for fresh insurance, but if you go for fresh insurance, your wage will be higher. Like for example, if you're taking term at 25, you are getting married at 35. So already 10 years gone. So the premium will be higher, the risk will be higher, so everything will be higher. So if you get the convertible plan at 25 itself, when you are converting at 35, the same premium they are going to charge. They are not going to do additional risk premium because your age is not, because you are not taking fresh insurance. You are taking the already taken insurance, you're changing that to something else. So there is no fresh underwriting needed. Underwriting is no need to go for medical test, no need to submit your medical records, anything. Whatever you've done at the age 25, it's enough. You can convert at any time. Then we have pension plans. We'll deal with this pension plans or annuity plans in detail in chapter 4. So child insurance plan. Child insurance plan is deferment plan. So you have a child and you want to save something for the child. Okay. So you can go for child insurance plan. So this is deferred assurance plan. Deferred is we are giving some waiting period. Deferment is waiting period. So for example, if you are taking for a child, the risk does not start at the starting itself. The child can be covered from 3 months to 18 years. Okay. So risk won't start from age month 3 itself. So the risk will start after the deferment period. Usually the deferment period they will keep at maturity, the major age, when the child is turning into age 18. Okay, though the risk will, at that time we will start the risk. So what is the benefit is at the age 18, they don't want to go for additional medical underwriting itself. The insurance is already there, so they can change the risk. For example, for when you are taking for a 3-year-old child, the owner will be the parents because they are going to pay the premium. The beneficiary will be parents. Okay, but after age 18, that beneficiary and that ownership will go to the child itself. It won't depend on the parents. So this is called child deferred assurance plan. So there are some terms you need to understand. Deferment period. Deferment period is waiting period. So when we are taking the policy to till the when the risk is going to the child, going for the child actually. Okay, so that is deferment period. For example, if the insurance is taken at age 3, if they are the deferment period ends at age 18 means the 15 year is the deferment period. So 15 year it is a waiting period. Anything happens, they are not going to pay the claim. They will wait till age 18. After that only they will pay. Okay. Deferment date is date at which the risk start. That is at age 18 usually. Okay. So commencement of risk. Commencement of risk is automatically starts on deferment date. When the deferment date is there at age 18, automatically the risk will start on the child. No fresh examination is needed. If you are taking a fresh insurance policy at age 18 for your son or daughter, that time they will ask you to go for a medical exam. But if you are taken at the younger age itself, that time there is no underwriting is needed. So this is called child insurance. So vesting and deferment are more or less same. Usually by the terminology or definition they may be different, but practically both are same dates. Vesting is the transfer of policy title. I told no that policy title of ownership beneficiary will go on to the child from the parents. That is called vesting. Okay. So that is the transfer of right. So date of vesting is when the transfer is happening. That is called date of vesting. Usually almost 99.9% of the insurance, child insurance policy, the deferment period and vesting period will be the same. There will be no change. So minimum age of the child for entry is generally 3 months. This is an exam question. You need to remember. Before 3 months, you cannot take. If the parents die, okay, before the full premium is paid, 18 years, what happens is the owner has been died, because owner before 18, owner of the policy is parents. The parent is died. Who's going to pay the premium? No need to pay the premium. Okay, the insurance company will waive off na vittu kuduthruvaanga. No need to pay the premium, but we'll keep the insurance, but we are not going to pay the benefit to the child because the child is very young. They will wait till age 18. After that, they will pay the benefit to the child when they attain the age 18. Full sum assured plus bonus, whatever is there, they will pay it to the child. So maximum sum assured is also a question. Since it is a child, you cannot take for 1 crore or 3 crore like that. You can maximum take 3 lakhs. Or if the parent has some other insurance, for example, parent has 2 lakh insurance, they can take for 2 lakhs. Whichever is minimum, they can go for that amount. If the parents has 5 lakh insurance, then they cannot go for 5 lakh. The cap limit is 3 lakhs only. If the parent has less than 3 lakh, then that parent insurance amount will be the child insurance amount. They cannot go more than the parent insurance because parents are the owner. They cannot take more amount on a child than themselves. Okay. So PLI, RPLI or postal life insurance, rural postal life insurance. So we already seen these are all not regulated by IRDA. They come under different laws. They are governed by government itself. Okay, the postal ministry itself, they govern the communication ministry of communication. They will govern this postal life insurance. Okay, so postal life insurance and rural postal life insurance has lot of names. So I cannot teach you those names because government has given different names for each and every policy. So you need to remember that. For example, Suraksha means whole life. Santosh means endowment. Anticipated endowment means Sumangal. So all are like Indian names only. They have kept the government has kept those names for those insurance. You need to read it and you need to remember. Bal Jeevan Bima child policy. Jeevan Bal means child. In Hindi, Bal means child. Bal Jeevan Bima, like that they will kept. Okay. So both PLI, RPLI has whole life, endowment, pure life, child life, everything, but different names. You need to remember those names. So rural postal life insurance, minimum sum assured is 10,000 rupees, maximum sum assured is 10 lakhs rupees because this is rural. So you cannot take more than this, like 20, 30 lakhs and all. Okay. So riders. Anybody know what is a rider? Okay. So riders are some additional benefits attached to the insurance. So they are not standalone insurance. Okay. If you're taking one insurance, additionally, you can take extra fitting like a car. So car, you're purchasing a car. So you want additional alloy wheel. So you can fit it. You want additional massage seat. You can fit it. So those comes with additional cost. Those are all called riders. So there are different types of riders. We'll see that. So riders, they come up with little less premium compared with individual insurance. Okay. For example, the car itself you can take. So you want to buy a car with alloy wheel, but alloy wheel will be there only in the top end model. top end model is 20 lakhs. So you don't want to go for top end model. So you want to go for a car which is 15 lakhs, middle model, but you want alloy wheel alone. Then they are saying like you pay 1 lakh rupees additional. I'll put alloy wheel on that one. So 16 lakhs you are going to pay, and you will get the benefit of alloy wheel, not 20 lakhs. Okay. So this is how the difference between a rider and a normal insurance. So you cannot take just alloy wheel alone, rider alone. You need to purchase a car. That is, you need to purchase a life insurance. To that, you can put additional fitting. You cannot straight away buy the rider alone. Any questions so far? So riders are limited to the maximum cover of the insurance. Benefit of the rider. For example, you're taking 10 lakh insurance means rider also you can take till 10 lakhs. You can take less also. You can take 1 lakh rider, 2 lakh rider, 3 lakh rider, but you can go up to 10 lakhs only. You cannot go more than the initial insurance, basic insurance. Okay. So in this also we have clause. We have called one insurance, one rider called critical illness rider. So critical illness rider, you can go up to maximum 100% of the base amount. That is 10 lakhs sum assured. If your high life insurance you are taking, you can buy critical insurance rider to 10 lakhs maximum. But for other insurance, you can go only for 30%. That means 10 lakh if you are buying, you can go for 3 lakhs maximum, not more than that. Any questions so far? Okay.
No.
So types of riders. We'll see different types of riders. They are additional benefit to the life insurance, not the separate insurance. Okay. So increased death benefit rider. Okay. For example, at age 25, you are taking 10 lakh insurance. Okay. And you did not take any rider. And after you're keeping that insurance till age 40. And age 40, all the cost, inflation rate has increased. After 15 years, the 10 lakhs is very minimal amount. At that time, at the age 40, if you are going to go and take additional 10 lakh insurance, it will cost more because your age has increased, the inflation rate, the cost of the insurance has increased, everything has increased. Okay. So instead of that, at age 25 itself, when you are taking 10 lakh insurance, that time you purchase increased death benefit rider. Okay. That means you are getting this rider. That means the insurance company is giving you the opportunity to increase your sum assured anytime, depending upon your liabilities. Liabilities means depending upon your need. That means 10 lakhs you need at 25. Maybe at age 40, you are thinking, I want to have an insurance till 25 lakhs. Yes, you can increase that without increasing the cost of the insurance. No need for additional medical, additional underwriting, nothing. They will, if you request, they will increase. But for that, you need to purchase that rider at the starting itself. Okay. The same example like a car. So car you are purchasing, they will ask, do you need additional warranty? Okay. 2 years is the warranty. Additional warranty you need. If you purchase additional amount, they will cover additional 3 years, 5 years. Okay. Up to 5 years, anything happens to the car, I will take care. No need to pay anything. This is an example of a rider. So extended warranty. So additional rider. Okay. Critical illness. Critical illness is critical. Something big, deadly disease. If you're diagnosed with any deadly disease, you cannot go to work. For example, someone has taken insurance at 25. Okay. Term insurance they have taken at age 25. At age 35, they have been diagnosed with cancer. But they are not dead. They are just diagnosed with cancer. They are bedridden. They cannot go to office. But so if they are not going to office, they are not going to get salary, they are not going to pay insurance premium. So you are getting stuck there. And insurance company is not going to pay your death benefit also because you are not dead. It will take at least you are going to take treatment for cancer, and it will take at least 3-4 years. Maybe you can cure the cancer also. You can live lifelong. But at age 35, there is some substantial amount you needed to take care of your family, to take care of your belongings, everything, because the salary is not there. For that, you can take critical illness rider. So critical illness rider, they will give the list of the conditions, what they are going to cover, like heart attack, kidney failure, cancer. These are all some examples. Paralytic stroke or major organ transplant. Like that, now in India, there are 40, 45 conditions they are covering. If anything been diagnosed, okay, at any age, they will pay the critical illness benefit. You need to fix the benefit. For example, you are taking 10 lakhs life insurance and you are also taking critical illness rider for 5 lakhs, additional 5 lakhs. Okay. So at age 35, somebody has diagnosed with cancer. So the insurance company is going to pay the 5 lakhs. Still the 10 lakhs insurance will be there. It will continue. They are not going to stop it. They will continue, but they will pay the 5 lakhs, additional 5 lakhs when you're diagnosed with any kind of the listed diseases. So this is called critical illness rider. Any questions? So major
Exactly, sir.
surgery. Yeah. Questions? Okay. So major surgical assistant, same like critical illness. They'll say they will list down the major surgeries. If you're going to undergo any of these surgeries, I will pay the amount that I have you're taken as a rider. Okay, so like critical illness also, we can take major surgical assistant rider. Accidental death benefit rider. Accidental death benefit disability rider. Okay, so there is two different riders. One is ABD, accidental death benefit. Another one is accidental death benefit disability rider. Okay, let's take an example. Same example, 10 lakh rupees you are taken insurance at age 25. At age 35, you met with an accident. Okay, and there is total disability. Total disability means, disability. Okay, so arms and legs are paralyzed because of head injury in the accident. So during that time, so due to accident, there is some injury. This is not critical illness. Critical illness is something, disease or disorders that is happening on its own. So this accidental death benefit rider is not kind of a stroke. Okay. So this is something due to accident, injury has happened. That injury has caused some total disability. You have lost your limbs, both the legs, like that. Okay. So if something happens due to accident, either death or total disability, they will pay the additional amount. For example, you can ask question like accidental death benefit. Anyway, death is going to happen. They are going to pay the sum assured. Why we need to take additional death benefit? Yes, you will get the double the amount of insurance. It's not double the amount, the rider amount plus sum assured. For example, accidental death benefit, you are getting 5 lakhs. Total sum assured you are taken as 10 lakhs. If there is any accident and death happens due to accident, they will pay 10 lakhs plus 5 lakhs. If there is any total disability happens, they will pay only 5 lakhs. But the 10 lakhs will be continuing. That insurance will continue. And if death happens later, after accident, somewhere after 10 years, death is happening, that time they will pay the remaining 10 lakhs. So this is accidental death benefit disability rider. And accidental death benefit rider, it does not cover disability. If anything due to accident disability happens, they won't cover. They won't pay anything. They will pay only 10 lakhs plus 5 lakhs if death happening due to accident. They won't cover disability. There is no part payment in between. So waiver of future premium. Same example. For example, I've taken waiver of future premium. Okay. Waiver of future premium is they are waiving off. They are saying no need to pay premium if something happens. So you're taken waiver of future premium, WOP. They will call it as WOP, waiver of premium. So you're taken 10 lakhs insurance with waiver of premium at age 25. At age 35, met with an accident and you got totally disabled. You can't go for job. You cannot pay the premium because there is no job, no salary. But you want to continue the insurance. If you are taken waiver of premium, they are not going to pay you any benefit, but the insurance company will say lifelong after the total disability, no need to pay any premium, but I will keep the insurance live for the entire life. If you live for 50 years also after the total disability, I'll keep it. If you die after 50 years, I'll pay the benefit to your beneficiary, to your family. Okay, so this is called waiver of premium. Guaranteed insurability option rider. So this is something like we have seen in the insured increased death benefit rider. Same like that. You can increase the sum assured anytime or in regular interval. Okay. Age 25, you are taken 10 lakhs. At age 30, you want to increase to 15 lakhs. At age 35, you want to increase to 35 lakhs. At age 40, you want to increase that to 40 lakhs. Yes, you can increase at any time without any additional underwriting. No need for additional premiums. Insurance will automatically increase as per your request. So this is called guaranteed insurability option. Okay. Any questions so far? No. Micro insurance. So micro insurance is name itself is there, small insurance. Okay. So this was introduced in 2015. So this is going to cover small income people who is doing coolie works, who's going for daily wages. Those people and all this is going to cover. So the sum assured will be from minimum 5,000 rupees to 2 lakh rupees for an individual person. If they are taking for a family, it is 10,000 rupees to 2 lakhs rupees. So maximum is 2 lakhs. They cannot go more than 2 lakh because this is micro insurance. If they want to go for more than 2 lakh, they will need to go for normal insurance. So key man insurance is for important employees. This is not taken by the employee, not taken by the staff. It is taken by the owner of the company. So if the owner of the company thinks that person is the key person, for example, a manager is there taking care of the entire tea estate. Okay. So if that person dies, nobody is there to take care of the business. So that tea estate will go in loss. So the maybe that owner has to appoint one more manager, but appointing a manager and manager has to learn that business, and it will take at least 1 year, 2 year for him to adapt to the situation and get profit. So for that 1 year, 2 year, that business will be in loss. To cover that loss, that owner takes insurance on the manager. That is called key person insurance. The premium will be paid by the owner. Okay. That if the manager dies, that amount will go to the owner, not to the manager's family. This is to cover the loss incurred by the owner. Okay, so owner is the policy owner is the beneficiary, owner is the premium paying person. Okay. So health insurance plan. So health insurance plan usually does not come under life insurance. Usually it will come under general insurance, like all the the Mediclaim policy that we have, that you have through your company, all Mediclaim policy or general insurance. But in life insurance also, there is a part of insurance where they cover health. Okay. So that is called indemnity type insurance. Indemnity is Some indemnity is something you lost. That loss alone I am going to cover. That is called indemnity. உங்களுக்கு 1,00,000 நஷ்டமாயிடுச்சு, அந்த 1,00,000 நான் பே பண்ண போறேன். That is indemnity. They are not going to pay the entire sum assured. You can have for the insurance for 10 lakhs also. But in health insurance plan, you can have for 10 lakhs, but hospital bill is 1 lakh means they are going to pay 1 lakh only. They are not going to pay 10 lakhs. They will reimburse the actual hospitalization expense in a lump sum. So we can take for the entire family also. So this is called health insurance plan. I think we are done quite in time, 45 minutes. Any questions?
No, sir.
So far, no questions. We are good. Okay, we'll take a 5 minutes, 7 minutes break. We'll regroup at 2020 and we'll start with indemnity. And that's a very small one. We'll cover it up easily. I will have a lot of examples to share also. Let's take a break. Thank you, everyone.